Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Warren Buffett is one of those people who makes investing in the stock market seem very simple, and for that reason I absolutely love him. I read so many books that he was either written by himself or other people wrote about him or he collaborated and so on. I've read The Intelligent Investor, which is based on Benjamin Graham's, which is one of the books that Warren Buffett basically that helped Warren Buffett and so on. Now, one of the things that I want to talk about today is this book called 7 Secrets to Investing Like Warren Buffett. It was written by his daughter-in-law and a guy called Sean. So what I want to do today is I want to give you some of the 7 elements or 7 things that he looks for, 7 things that are important to him. The book that I'm talking about is this book here. This one here. So it's called 7 Secrets to Investing Like Warren Buffett. Now, this book has a lot more information than what I'm about to give you today. So it talks about things like the power of having a habit, for example. The power of habit, watching your spendings, for example, avoiding debt, risk management, taking care of your health. So at the beginning of that book, they talk about looking after yourself and making sure you don't have any debt, just to giving you basically normal advice that you should obviously before you start investing, obviously, right? And then they talk about basically the stock side of things. Okay, so what is value investing, how to look for companies, and so on. So it goes into a lot more details. It's about quite a small book, about 200 pages, I think. One of the nicest books that I've read. It's easy to read. It gives you nice little ideas, and I've annotated it so much. It's actually quite nice. It's just like easy book to carry around. So yeah, that's one of the books that I've absolutely enjoyed reading. I'll put the link down there if you would like to order or whatever. So let's get started and let's look at some of these ideas, some of these things that I thought it would be good to share with you guys today. And before I do that, can I ask you to subscribe to the channel if you haven't already and give the videos a like. Honestly, it takes a lot of time to put these things together. I do have a full time and a family, so some days I genuinely can't be like, I don't have the time to do it, but I make time these days because I do enjoy creating these videos and I hope you benefiting from it as well. Right, so the first thing that he says is buy businesses, not stocks. And this is, to me, like really is important. All of these things are important, but this specifically is really important because a lot of us right now are focusing on the stock side of things. With stocks going up, this going down, we just focus on that. We don't think about the underlying business. We don't think about, okay, what do they sell? Okay, is the products they're selling in demand? Are they good company? Are they helping society? Are they actually doing good things in this world and so on, right? As well as that, think about the business, analyze it like a business, not like a stock. Look at the company's revenue, look at how much they're spending. Because remember, every single business will make money and spend money, and then they will have leftover. That leftover is quite important to us. That's your free cash flow. That's your net income, if you like. And if the company, imagine you basically open a little shop, right? And all of a sudden, basically this month you made £200, next month £300, next month 400, 500. That's a healthy business, and you've got you don't have any debt. That is what you need to look. That's how you look at these companies. So you look at them as a business, not as a stock that just goes up and down, up and down. Because if you focus on the stock, then you're gonna give yourself a headache, and you're gonna sell that business. As soon as it goes down, you will sell it. Why? Because you don't really understand the business, or you don't know anything about the business, or you don't care about the business. Okay, they could just imagine if they just invest in $100 billion on a new product that they basically the world is in need of, right? And you just sold the stock because it went down. Whatever the case might be, you really need to think about that. Okay, so think it as a business, not as a stock. The next thing he talks about is having that circle of competence. Okay, there are things that you know, there are things you don't know. For me, I struggle with healthcare side of things because I've never worked in healthcare and I don't know a lot of the drugs these companies sell. So I'm going by based on my research, right? But when it comes to technology, I can predict where things are going because I work in tech and I know what is in demand and what is needed and so on. So it's easier for me to analyze. The other thing that's easy for me to look as well is the consumer staples, companies that sell products that we buy every day. So stay in your circle of competence, things that you know. Okay, it says here you only have to be able to evaluate companies within your circle of competence. You don't have to go outside. The size of that circle is not very important. So it doesn't mean like you have to know everything, or basically, okay, the size of that circle is not very important. Okay, knowing its boundaries is, that's the most important part. So that is the circle of competence. The next thing we're looking at, and again, this is genuinely important. If you don't know anything about technology companies, then just leave them. Okay, you might want to have 1 or 2% just to be able to, obviously, in order to be able to either beat the market or whatever, you might have to have 1 or 2%. I'm not saying you have to, but just think about adding those. And I'm not just saying for tech, I'm just saying generally, like if you're talking about consumer staples, healthcare, consumer discretionaries, utilities or whatever. Okay, so stay in your circle of competence. The next thing is looking for companies with sustainable competitive advantage, or what's called economic moat. And this is something Warren Buffett talks about a lot. In every time he opens his mouth about any business, he talks about this. Okay, and it's genuinely important. It is really important to know if a company has a competitive advantage. Okay, so what that means, what is the company selling? First of all, find out what the company is basically selling. Okay, is this value provided by anyone else? So if they provide some value or services, find out if someone else is doing the same thing. Will I choose to get this value from this business or somebody else? Okay, so that's how you determine. So you're asking these questions. Can I get this product from somewhere else? Okay, and that's how you determine if a company has economic moat. Why, will you choose to get this value from somewhere else, or why would you rather basically get this from somebody else because it's cheaper, because it looks better? So once you've determined those things, you will know if a company has economic moat. And these days it's quite easy because there's so many information online. Back in the days it will probably be a lot harder, but right now there's so much companies out there, and you just have to use the internet to find out basically if these companies sell the same product, if their product is actually better, if it's the same, if you think the company that you're about to invest in has actually that economic moat or has a competitive advantage. Okay, so some of the established companies, for example, Procter & Gamble, for example, is one of those companies that have a wide economic moat. The reason it does that is because it's a brand name, number one. It's been around for generations, and any new companies that come up that are doing really okay, you know what they do? They buy them. They basically acquire that company as soon as they come in the market. So it's very difficult to compete with them because they have so much cash. Okay. Yes, they kind of monopolize in the market. There's about 3 or 4 companies that do that, like Unilever and so on. But it is important to understand if the company that you invested in has a competitive advantage, because that in fact, what will that do for you is in the long run, okay, this company will be around, it will be sustainable, it will be fine. You don't have to worry about their business. But if you basically buy a company that has no economic moat, another company comes in like Amazon and takes them out of business completely, then you're going to lose a lot of money. Okay. So Warren Buffett says the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company, and above all, the durability of that advantage. And that to me is really important, that durability. How long is this going to be around? The product or the services that have wide sustainable moat around them are the ones that deliver rewards to investors. And this is, again, very important. If they have wide sustainable moat, then obviously you will benefit from that in the long run. Right. The next one is focus on the long-term intrinsic value or short-term earnings, and not the short-term earnings. Okay, and that's important. So like I was saying earlier, you don't have to focus on the companies basically like what they've reported these earnings or whatever. You need to focus on the long run. You need to think about 5, 7, 10 years from now, what is going to happen to this business. Okay, are they going to be around? Are they making profit? Are they going up? Is the revenue going up? Is the net income good? Do they have free cash flow? Would they pay me some dividends while I wait for my, just for the next 10 years? Okay, and you don't think about the short-term things. Okay, the short terms could be the price fluctuation. Okay, it might be this quarter the revenue is down because of maybe they had a supply chain issues. And this is one of the reasons why, as a value investor, you look for companies who have been overlooked by investors because of these short-term earnings and short-term, basically, situations that's going on. So that's, again, is important. So think about the long term. And genuinely, because of what's happened 2020, a lot of people are like short-term investors. Everybody was looking at just companies to buy right now and then sell it next month. So focus on the long run, and genuinely you will be fine. The next thing we're looking at is demand and margin of safety. This is something that is really important to all of us, and it's a mistake that I still make. What this means is, when you're buying a stock, okay, you have to, if the company, once you've done your analysis and you realize this basically price of that stock says £20 or $20, right? Give yourself a margin of safety, okay? Wait for that stock to go down to maybe $15 per share. That $5 is a difference between basically having a margin of safety and not having a margin of safety. Because if they say it's 20, it should be £20, and it hit £20 and you buy straight away, it could go down further, and then you might. So that 5%, okay, that intrinsic value, if the intrinsic value of the business says the price should be $20, wait for it to be maybe 20, or basically just, let's say, $15 to $17. And this is one of the things I was doing in 2020. A lot of the companies that I was investing in, basically they were going up every single day. And then once I found the companies that I really liked, I waited for them to come back down to me. And honestly, that's one of the reasons I found my portfolio is still up, because of that, the margin of safety. I'm not saying I'm perfect. I still make mistakes. I bought Adobe when it was basically so high, and I didn't give myself enough margin of safety. I think I'll give myself about 5% or something, but 10% or more for a high flying company like Adobe and Salesforce, that will probably give you a better chance of hopefully making good money later on. So the next one is check the management team. So this is, again, important, and something that I'm guilty of not doing as much. You need to know the who's running this business, okay? If you find out the person who's running the business is the owner, the person who came up with this business, the person who actually started the whole business, then is really good. That's why I sometimes look for companies that are, especially with the tech world, companies who basically have a management that have invested interest. So if you started a business, you're not going to get it, you're not going to run it to the ground. And sometimes look at the experience of these people, okay? Sometimes look at their track record, for example. What companies have they worked in before? Like, look at the companies they've started, the companies they sold. Why did they sell? What happened? So look at the team as much as you can to learn a bit more about them, because then you will feel safe and you will know, okay, you know what, that business, I like the manager. So for example, one of the companies that I invest in is Union Pacific, and I've recently was reading about basically their CEO, and I found out he's been there for a long time, and he actually genuinely cares about the business. So every time I basically see his videos and read about him, it seems that he's got invested interest. So for that reason, I wouldn't worry too much about the company making bad decisions because it's someone really cares about that business is running it right now. Okay, and the final thing is be patient. Okay, investing can right now, especially if you could be down right now 10%, 5%, 20%, whatever. You have to be patient. You have to think about the long term. You have to think about your goals. What do I want? If you're in 20s, in 30s, right? Say you got another 20 years of investment journey, right? Then why are you worried? Why are you worried about, I don't know, Procter & Gamble or, I don't know, Microsoft going down 5-10%? Buy more and hold it and forget about it. Okay, be patient. The stock market will go up, will go down. There will be recessions, there will be bear markets, there will be all sorts of things. One thing you need to do is be patient. And genuinely, that's what I'm doing right now. You've seen my portfolio. I'm buying more every single week. I'm adding to my portfolio. I can see that cash flow coming in from those dividends. I'm reinvesting that. Okay, right now, I'm in that stage where I'm building this portfolio. And no matter what happens in the stock market, inshallah, I'm going to be invested and I'm going to be patient. I'm going to stay in the market and focus on the long term. Okay, and that's all I have to say about this, because it's genuinely is one of those things. Right now you'll buy stock and a couple of weeks down the line it's going down, and you just feel down about it, and that's when it's normal. Like, we're human. You don't want to see, no one would likes to waste money. No one likes to basically lose money. Remember what Warren Buffett said, right? He said, rule number 1, don't lose any money. Rule number 2, don't forget rule number 1. Okay, so always think about not losing the money. And if you don't sell, genuinely right now, if you're down 20% on one stock, if you don't sell, guess what? You're not going to lose any money. So just be patient, hold on. Okay, and that's exactly what I do week in, week out. I've been adding money to this portfolio, and you can see companies like Salesforce and Adobe's, whatever. I'm down over £300 there. I'm down again here. I think it's coming back this week. $112 right now, £12 right now. Unilever is a great example. I've been down since I've started this YouTube, I think. Okay, £140 down. Again, it's coming back. But you know what? I love the business. I'm gonna buy more of it because I just need to be patient. You will be rewarded, and guess what? You will definitely be rewarded. Air Products and Chemicals was down about £300 not long ago. This company, Amgen, actually, since I started buying, it kept going down and down and down to the point where I was like, what the hell is going on? So I bought 10 shares and I left it alone. Right now it's almost to £500 up, or 28% up. So I've seen that. Okay, one of the other companies that did that to me is the Cummins, for example. It's down right now, but it's just a little bit. It was down about £300 not long ago. So every single company in here, again, the opposite is also true. Home Depot at some point was about £500 up. Right now it's only £270 up. So it can happen. Finally, Merck was a great example, right? If you watch my old videos, I used to talk about Merck a lot when it was really undervalued, right? When it was like 60 something, $70 per share, right? And I kept saying at the time, this company is undervalued. And I just stayed and I kept buying more and more. I wish I bought up to 30 shares, right? Right now it's $94 per share. And yesterday, guess what? They actually paid me yesterday a nice dividend. I think it was about £14, whatever, £13. Just holding for this 27 stocks or whatever that I've got. So you have to be patient. You have to think about long term. I hope you enjoyed that video. Have a wonderful day. Assalamu Alaikum.